This might be the most interesting perspective. If you take a look at the system or house of cards that we built, here's the most interesting thing is John Jones of Modesto, California, who's paying his mortgage and keeping the cash flow going, is keeping the whole system going. So on the back and shoulders of John Jones of Modesto, California, the entire system rides. It's true. And on top of that, the U.S. government, because we're coming up with the losses and covering the losses. So basically, the irony of it is the subprime borrower, and of course other borrowers, are the ones who kept the fat cat banks, being able to, buy the assets on Monday, package them, and sell them by Friday, and generate an enormous profitability. The financial sector, as I recall, in the S&P or 500 was 35% of the market cap of the stock market. So the fees generated out of this were absolutely enormous. And so, but what kept that stream going was good old John Jones. And if you think about it, everyone in this chain got 1 or 2 points. They got 1 or 2 points. So John Jones was supporting all these folks it shows you two things. He wasn't paying that much for the money, but the foreign saver was willing to accept so little that it left room for fees to be extracted on the way from the foreign investor, from John Jones to the foreign investor. A lot of fees. As compared to the old S&L system, you only had one intermediary. Now we have 5 intermediaries, and each of them have to be supported royally, or else you couldn't build this system. So there was huge fees and huge income, and certainly as compared to a lot more competitive S&L system, which undoubtedly is going to the regulators are going to suddenly appreciate them again. All right, let's go through the perspective very quickly. It's both summary and perspective. Number one, what we saw was a once-in-a-lifetime prosperity in the sense of taking such a major part of the world and turning them from less developed countries to emerging nations with a great deal of wealth. And what that wealth did was create high savings rates and a huge amount of wealth to be invested all at once. It turns out it went to the U.S. market, and it went to the housing market. And by the way, it didn't only go there. In 2006, 2007, the wealth got spread out. And the hedge funds spread it to a lot of countries. The iBanks spread it to a lot of countries. One of my favorite readings in class, I wish I brought it. It was a hedge fund manager. It was in April 07, and he had just gotten back from a world tour. And the name of the article was, "It's Everywhere in Everything." Namely, it's the first time he's ever seen a worldwide asset bubble in every asset class, in every place in the world. That's how much the money, toppled over. Now, it turns out that we now built a banking system not only to finance, like in the old days when teaching money and banking, it was really to finance you and I as a consumer to buy goods. But the banking system is also financing the purchase of financial assets. So when you have this ramping up of the banking system, it not only ramps up goods purchases, but financial prices as well. In fact, the financial prices were far more susceptible than the goods prices, because the U.S. economy was doing okay, but we weren't totally, what's the word? We were doing by the way, how well the U.S. economy was doing. I meant to show you this and I didn't. Page 1 and 2. Home equity extraction, it's called. Basically, not only could you borrow money to build a new house, but you could refinance your house. As the house price appreciated, you could refinance and take cash out, and that's called home equity extraction. And home equity cash outs is column 2, and this is by year. This is the U.S., and this is the cash outs as a percentage of personal consumption expenditures. So the boom of these years, the post-tech bust, was almost basically all financed abroad by us borrowing against our house, and it financed half of our expenditure. I guess this is the cumulative total, 46% above housing purchases of us buying whatever, golf clubs, boats, second houses, etc., was financed abroad, and it was all put on the credit card of the house. So when you have foreign financing, it not only pumps up asset prices, but it also generates income, and it generates a revved up economy. Number two, the foreign capital swamped the financial market with a willingness to lend in what was represented to be high-quality debt by their ratings, by their underwriter, and as per the insurance brand, i.e. AIG. It created a worldwide spending spree and asset bubble. And by the way, the perpetrators of the money were like hedge funds going across the world, and the iBanks. Number five, debt, and I should have had a graph on this, but didn't. The debt relative to income in the United States grew dramatically from about 70% of, 70% of income to 100% of income. So we had, that's quite a ramping up. That's about a 40% increase in debt relative to income during these few years. So now we have the job of paying it off, and we are now paying it off in record amounts. And paying it off in record amounts also means that the economy is depressed because we're taking our income to pay the debt that we accumulated previously. The Financial Titanic in this case was confronted by loan delinquencies. The question, the real Titanic sunk because it hit an iceberg. The question is, what was the iceberg in this case? The iceberg was what put the whole thing to an end is, if you can imagine, we ran out of qualified borrowers who could borrow and pay loans back. I've looked at asset bubbles in the past. Asset bubbles usually end when you end up with no more purchasing of the asset, no more purchasing power of cash that they want to buy that asset. In this case, there was plenty of cash lined up, hundreds of billions the day the music died, but we didn't have anyone who could still service debt. And that's what was the iceberg that we ran into. Very unusual. We were looking in the wrong place. Very frankly, in class for about 2 years, I was forecasting something like this. And in my opinion, the way I thought it was going to end was that the foreign investors will have had enough of U.S. assets and saw that they were investing in a place built on a house of cards, and that they would say we had enough U.S. assets, which now is occurring, for example, with the People's Bank of China. They say they want a diversified portfolio now. I thought that's how it would end, but it didn't. It ended up by having a shortage of qualified borrowers. Let me run through this quickly. I know I'm over. So that's number 8. Asset values crashing at all banks. The thing is, when banks across the world are going down trying to sell their assets, usually who steps up to buy those assets are other people who are solvent in that same line of business. But there's no one solvent in that same line of business. So to sell these assets and find someone who would take it off their hands, actually, I bought some residential mortgage-backed securities through Frank when the price got low enough. So you got to appeal to someone outside of this milieu to buy bank-type assets, and there were very few willing to do that. It's not exactly what you call a consumer product, residential mortgage-backed securities. Okay, number 9, the lenders via the covenants led to the margin calls, the PCA, which is now stopped, by the way. The government is turning the other way, and they're ignoring the law, that they're not shutting banks down, they're insolvent. They've just, it's a law they're not enforcing. The financial guarantees were worthless. Number 12, to close the bank or support it. This was a systemic run. Most of our reflexes on taking a bank that's insolvent, you shut it down. That's okay if there's one bank. But if it's the whole system, then you have this cumulative bill going out to all of us. So basically, the government was put in the uncomfortable position, and they didn't like it, of having to support the existing entities, because the bill to us would be a lot greater than if they let it go, and they'll get around to the criminal charges later. All right, let me go to 14. Are there other less costly solutions? Well, I guess I'll get to that in that bailout lecture. There are less costly solutions, and I'd like to have some lawyers' opinions on that, but I'll leave it for now. Obviously, one obvious one is we need banks. It's not necessarily we need these banks. These banks can be put in liquidated slowly, but to do so, you need active lenders. And what we don't see with the government is fast-tracking new bank charters. Let me just get to the blame game, because I know people will get into that, and then we'll say our final adieu. The blame game, the Fed. A lot of people blame the Fed because they think a lot of the ramping up of the spending came from the central bank, and I think that's basically that's kind of consistent with what you probably learned as an undergraduate, that the central bank ramps up credit and we buy. In this case, it was foreign capital, not our central bank. I looked up the numbers recently. The Fed was well behaved. Page 6, very very quickly, shows this little bar histogram is the money supply of all the G7 banks. So you see the developed world banks didn't finance this thing. And this is the tall histogram is the derivatives outstanding. So it didn't get financed by the banking system. It got financed by foreign capital and non-G7 banks, by the way, some non-G7 banks. But the Fed has taken a big rap for this, and I think it's basically because you had an undergraduate class that said the Fed is in charge of ramping up credit, and they got a lot of blame for it, which I think is totally undeserved. You have principal-agent problems. Yes, we do. The question of principal-agent problems is a problem of, are those who are putting the deals together and taking the front-end bonuses and putting in the money in their pocket and putting the franchise at risk, is that a conflict? Because the principal gets stuck with the bill and they take the money and run. And I think that's probably true in a lot of cases, particularly AIG. But I'll tell you something very interesting and ironic. Citibank. Charlie Prince, who was the previous CEO, was chided by his own stockholders that he wasn't ramping up profit as compared to his peers, and forced him, at the threat of firing him, to take more risk and generate more profit. So here we have an agent, Charlie Prince, trying to say, no, we can't do this, and the stockholders are telling him to do it. So in some cases it was perverse that way. Namely, the agent was the one, the principal was the responsible, not the agent. And in some cases it indeed was the agent, not the principal. So you have to differentiate it. Don't just think it was the bonuses. But bonuses did have a problem because it creates an incentive problem. Namely, if you take the money when the loans are made as opposed to when the loans are paid, loans made versus loans paid. Have you ever get in control of a financial institution, make sure your incentive system is when loans are paid, not loans are made. The S&Ls learned it the hard way, and these institutions haven't learned it. They took the money up front and ran. So that is a major incentive conflict. Who else? How about D? The SEC has to come in for blame because the SEC lowered the capital ratio for the investment banks in 2004 from 10% to 3%, given industry pressure. In other words, the Secretary of Treasury is the one, when he was still chairman of Goldman Sachs, went into the SEC and said lower the capital requirements from 10 to 3. And then as Secretary of the Treasury, made sure AIG was able to pay its financial guarantees, of which $6 billion went to Goldman Sachs. We never heard another peep out of Henry Paulson after that. If you noticed, he never said a word between August and November when he was out of office. And if I were him, I'd be in Switzerland right now. That's going to be an interesting story. The role he had in constructing the downfall. Part of the blame in the blame game really does go to the government, who had a concept in mind that if you give a financial guarantee, it's a costless subsidy. If the government guarantees like Fannie and Freddie debt or VA debt, then the veteran gets the lower interest rate and has a house. And for so many years, it never came home to roost. So they paid a lower interest rate. The interest rate was lower because the government guaranteed it. And for many, many, many years, those guarantees were never called on. Well, they all got called on in October, what was it, 08 or whatever, and now we're paying out to the tune of about $25 billion a quarter with no end in sight. So it's a fallacious assumption or thought that government guarantees are a costless guarantee. They thought, because there was never a budgetary item. And it always worked, and so they overdid it, and it worked until they did too much of it, and that was it. So as far as I'm concerned, that's kind of the blame game. I guess the other thing you can blame it on is how could these people not have any perspective of what they were doing? At some point, the music would die because I think a lot of them had a sixth sense of it. But when the mortgages roll in on Monday, you can roll them out on Friday and charge 2 points. They didn't want to think about it. Well, thank you very much. I enjoyed it, and I hope you did too.